This week, we witnessed history in the crypto space as the first crypto-friendly piece of legislation ever has just passed the Senate, and we can expect that this bill will become law, effectively greenlighting the first versions of crypto with national legislation in the United States. This is one of the biggest moments in history, and from this, we can extrapolate systemic changes that are going to hit the entire crypto space. And in my opinion, this will affect a significant chunk of projects, types of projects that have not had the limelight over the last several months or even years. And other bills that are set to be voted on later this year with the same Congress will also likely pass and affect the space. Understanding what's happening right now on the legislative front and looking into the crypto space to see which projects have been totally ignored over the past few months and years of meme coin dominated hype cycles. Today I'm going to be deep diving into the other side, the deep dark side of the attention liquidity barbell, talking about projects with extreme utility and market dominance that are just simply not the darlings of the speculative mania in crypto land. Hope you guys are excited for this one, and if you appreciate all the research and time that goes into a video like this, please do me the favor of smashing that like button. It's a really easy way to help show that you appreciate the content, and it helps that YouTube algo get this out to more viewers. Now, some of the stuff is dense, and I know if you're here on crypto YouTube, you probably want me to chew up the food and feed it to you like a mama bird. So that's what I'm gonna do. Call me Mama Ellio. I got your back, fam. All right, enough of that. Let's dive in here. Bitcoin has just been making all-time high after all-time high, and yet the social metrics are ice cold. We can assume that not everybody owns Bitcoin. Most people own altcoins. Obviously, I own Bitcoin, but I'm heavily weighted into altcoins, as you know. So we have really not yet hit this retail mania, this altcoin season that we've all been expecting. But for the first time in forever, it feels like the signs are there, with Ethereum making steady progress against Bitcoin. Yet, let's be honest, there's a lot of room to go here for Ethereum to actually make a comeback. Two completely historic things happened this week, and they have everything to do with what's happening next in crypto land. Check this out. The United States had one of its worst 20-year treasury auctions in history. Here you can see that the complete lack of bidders drove the 20-year note up to 5.1%. The less bidders there are, the higher the yield has to be to attract buyers. The higher that yield goes, the more the United States is going to have to pay on its interest. You know, its national debt, the debt clock. The higher that goes and the higher this yield goes, this becomes exponentially worse, creating what's called a debt spiral. Now, it's widely suspected that the United States will need big buyers to step in and buy those treasuries, to buy those bonds. Otherwise, it's going to have to print money and buy its own bonds in what's called yield curve control. Now, if we get to yield curve control, that's the path for Bitcoin to accelerate rapidly to $1 million. Of course, rapidly could mean a few years, but who cares? A 10x on one of the biggest assets in the world is nothing to snub our noses at. But something else happened this week that is equally historic, if not more historic. And no, when we're talking about defaulting on the debt, we're not talking about the Chipotle burrito loans. Of course, those are your AAA loans. No, we're talking about the junk-rated McChicken loans in that Klarna bundle. You definitely don't want any McChicken loans. Those are not coming back. Those are gone. Might as well kiss that goodbye.
So the stablecoin legislation requires that each dollar stablecoin be backed fully by either a dollar in cash or short-term treasuries. To do that, the stablecoin issuer has to go and purchase short-term treasuries. Already, stablecoin issuers are large owners of treasuries, and by 2030, Citi projects that stablecoin issuers will be the largest owner of U.S. treasuries in the world.
That's right. Not only did we pass the stablecoin bill, but this directly impacts the biggest problem that America's facing, which is we need buyers for our national debt. The harmony between US dollars on the blockchain and the demand for essentially short-term US government debt is perfect. It's a perfect synergy. And this isn't new because USDT, Tether, the biggest stablecoin in the industry, has been one of the biggest purchasers of US debt in the world. In fact, they are about to flip Germany in their total US Treasury holdings. In 2024, USD Tether was the 7th largest purchaser of United States debt in the world. I don't know if you can fully wrap your head around this, but a crypto coin being a bigger buyer of US debt than most nations in the world is absolutely insane. And this is pre-legislation. This is before the legislation goes live. So we can assume what happens next once they unleash the floodgates and fully legalize this type of currency, really give it legal protections and solidify it. Well, the amount of people that will feel comfortable holding stablecoins and the size, the sheer quantity of stablecoins on the blockchain is expected to reach the trillions in the pretty near future. There's another big benefit of stablecoins, which is people all around the world can readily access US dollars. Anyone with a phone, anyone with access to the internet can now convert their currencies into dollars. This is going to effectively lead to dollarization of the entire world. I mean, if you were living in Argentina or a country with rampant inflation, you could easily just convert all your money into dollars. And instead of effectively holding your coin version of fiat, you can now hold the gold standard of fiat, which is the US dollar, even though, of course, we know it has problems itself. So this is amazing for everyone in the world who gets to now hold dollars, and it's amazing for the United States. There's pretty much no downside to this, which is why it's such a huge deal. But where it gets really interesting is understanding that this is going to be huge for on-chain finance. These applications in decentralized finance are going to benefit tremendously. So today we're going to look at the biggest and most dominant protocols in decentralized finance. While this is not a comprehensive list, I'm pointing out some extraordinary performers in the DeFi landscape and explaining what they do and why they will benefit with this increase of US dollar stablecoins on the blockchain. First and foremost, we have Hyperlquid, which of course has been a darling of the channel and one of the biggest and most impactful projects in all of crypto. Hyperlquid is so successful that it's making millions of dollars per day that they're using to then buy back their own tokens. If you extrapolate their daily revenue, they're making over $1.3 billion in fees. And this is a $30 billion protocol. So effectively, they're able to buy back such a significant chunk of their own protocol, which they are doing now with these fees. They're able to buy back so much of these tokens that it's actually an incredible flywheel. The degeneracy of crypto has been taken on-chain with Hyperlquid, the gold standard in perpetuals trading, and that price action, don't lie. From the bottom making, what is this? From $8 at the bottom of the recent dip up to 34 pretty much. So a complete massive pivot. And these are billions, right? So you have from $8 billion market cap up to $34 billion in market cap, a clean 4x out of Hyperlquid. Very, very interesting. And the flows are just incredible. You can look up the actual flows into the blockchain and this doesn't lie. Hyperlquid is so successful that actually CZ and Star, who are the heads of Binance and OKX, are actually what it looks like, collaborating to try to stop Hyperlquid from growing. They've been suspending deposits to Hyperlquid, allegedly. And most centralized exchanges like Coinbase and Binance have refused to list the Hype token. This has led many to believe that they are pretty much scared that Hyperlquid is going to take over their business with such a successful push into decentralized perps trading, which is the biggest version of centralized exchange trading. Now, the reason why stablecoins will be really good for Hyperlquid is that most people start and trade in and out of stablecoins on Hyperlquid. So the more stablecoins there are, the more liquidity a protocol like Hyperlquid can attract. Now, let's be honest, you probably know all about Hype. So let's talk about some incredibly dominant protocols that you may not be as familiar with. And the first one I'm going to be talking about is Pendle. Now, Pendle Finance effectively does something called liberating yield. And this is the world's largest crypto yield trading platform. Now, let me mama bird this one to you really quick. Pendle effectively allows you to split tokens from the ownership of the token and then the future yield of the token. For example, if you're holding the Athena stablecoin, USDE, and you stake it, you get a yield out of that token. But say you want cash today and you're willing to sacrifice your yield tomorrow. What Pendle allows you to do is keep, say you have $1,000 of that token, you can keep your $1,000, but if you were to hold that token, you might be expecting $50 of yield from that token over the next year. You can say, hey, look, I need cash today, so I'm willing to sell that $50 of yield for just $25 today. Someone could say, hey, I'll give you the cash today and I'll take the future yield upside. So Pendle has created this new model where they split the yield and the principal, and they are incredibly dominant. According to Blockworks here, they hold a 90% dominance in this particular vertical, and they're a prime beneficiary of this yield-bearing asset stablecoin growth. You see, many believe that with the growth of stablecoins and the legislation of stablecoins, all of the money being made by Tether, which is one of the most profitable companies in the world, will effectively be passed on to the consumer. You see, if you could hold a stablecoin and it automatically generates yield, you don't have to then go put it in the money market or do something with it to generate yield. That is a huge unlock. And it's widely suspected that most people will take the yield being earned by effectively these stablecoin issuers like Tether and just offer it to the consumer. So if you're holding, let's just call it new stablecoin 1, well, you'd automatically get access to whatever the yield being paid by the US government is, the treasuries that, remember, these stablecoin issuers are going to be buying a bunch of government debt. Well, they get paid to do that. And that yield is going to get passed on to the consumer. And this will directly benefit a protocol like Pendle. and of course, Athena, right? Athena is a big part of this. And in fact, Athena accounts for over 50% of Pendle's deposits, which is a 90% dominance in this field. So something to consider. Athena and Pendle are highly synergistic protocols and both massive beneficiaries of this new legislation. Athena, which we've talked about, of course, allows you to take advantage of what they call a cash and carry trade, where they take your money and they take a delta neutral strategy on exchanges. Remember when we talked about Hyperlquid, how it's got this insane rise in dominance? Well, that allows you to long and short cryptocurrencies. When you're long or when you're short, sometimes you'll have to pay fees to hold those positions. Those fees can get really exorbitant. So Athena allows you to effectively farm those fees without doing anything. They handle the complicated stuff and you just allocate money to it and get a yield. When the market heats or overheats, those yields can be tremendous. In the mid double digits, meaning 20 to 30% yields if there's actually heat in the market. That's a crazy amount of yield, and that's why this stablecoin has become so popular. You can just buy a stablecoin and get this insane yield being generated by these perps dexes. Next, we have Maple Finance, which is pretty much the dominant player in institutional on-chain lending. Again, with massive amounts of new stablecoins hitting the blockchain, stuff like this is going to be huge because there's just going to be more liquidity for people to take their Bitcoin and crypto loans against. And the same can be said for Aave, whose TVL is absolutely tremendous up and to the right and is pretty much the gold standard of on-chain lending ecosystems in crypto. If you remember back in 2020 and 2021, Aave, which was originally called ETHLend, went on one of the most intergalactic rippers of any coin we've ever seen, reaching an ultimate high of about $600. And since then, it's been pretty muted. It came all the way down here to about $50, and that was the floor here for Aave. Since then, it actually has pushed up, and it's sitting about 5x from its floor, which is really nice for an altcoin. Most altcoins are not sitting on those types of gains from the bear market lows, but it's quietly been pushing back. And with all of this legislation, things like Aave, things like Pendle, and even newer coins like Maple's Syrup, and of course, even Athena here, which is sitting very close to its range lows. Those are types of projects that I could see getting a tremendous amount of long-term flywheel type growth from legislation like this. Now, of course, just because the protocol is incredibly successful doesn't mean the token is going to perform. But I believe that as institutional investors from the stock market, from more traditional finance or TradFi, start to look at crypto, they're going to look at the long-term beneficiaries of structural changes to legislation and to the economy. They're not going to be buying Fartcoin. I'm sorry. They're going to be buying long-term infrastructure plays that will gradually start to eat away market share and become so dominant that they cannot lose. Those are the types of plays that long-term will behave more like traditional equities, where you have the Googles, the Amazons, the Facebooks that just continue to grind up year after year after year because they are completely dominant in their respective categories, versus the very reflexive hot ball of money type meme coins, which are fun to trade and very well might print insane gains on a short time period. That's not what institutional investors are looking for. And remember this whole graphic about how we're at Bitcoin all-time highs and no one cares? Well, it's because most people haven't been buying Bitcoin. They've been buying very sexy, very cool altcoins. Again, I'm guilty of the same thing, but most people are not overweight Bitcoin. It's all the institutions that have fueled this entire run. And institutions have a totally different palette for what they want to buy. I believe that these changes that have just occurred this week, that have legalized stablecoins, the horrific bond auction, and all of the flywheel effects that are going to come from the stablecoin legislation will be extremely bullish for these DeFi protocols and probably many others. These protocols and these tokens aren't ones that are widely talked about. Remember the attention liquidity barbell? Well, the attention side of the ecosystem gets, as the name would suggest, a lot more attention. But the liquidity side, that is going to see a flywheel kick in here from the stablecoin bill legislation, well, that side of this is going to be dominated by institutional capital flows. And I believe these are protocols that you need to have on your radar if you want to know what these institutional type plays will look like. You want to get ahead of the big boys. I believe that these are the types of protocols that you want to be looking at. Obviously, if you saw my last video, the Superverse is launching its own on-chain liquidity hub called Blackhole, and understanding the barbell of liquidity and attention and the different types of buyers for those assets, the different types of life cycles for those assets, that is top of mind for me in understanding how to navigate my own portfolio going forward. I hope you guys enjoyed this video. If you did, if you learned something, make sure to leave a comment. And of course, please like the video. If you want more videos like this, please subscribe. And of course, most importantly, please check out this video popping up right now because I'm sure you'll love it. Thanks, and I'll see you very soon on the next video.